I quit running EAs because I did not trust them. I went manual trading for 2 years, took every course, joined every academy, blew through every strategy you've ever heard of. Then I listened to one book, 3 times, and I went straight back to algorithmic trading. And this is why. In the next few minutes, I'm going to take the 5 core ideas from one of the best books any trader should have, Trading in the Zone by Mark Douglas. And I'm going to show you why every single one of these is an argument for algorithmic trading. By the time we're done, you'll understand why I stopped trying to be a disciplined trader and started building disciplined systems instead. Here is that embarrassing part. The first time I tried algorithmic trading, I had no idea what I was doing. This was back in 2019. I bought a black box expert advisor. I didn't understand the code, I did not understand the strategy. I just trusted that whoever sold it to me knew more than I did. Well, they did not. It lost money. So, I made what I thought was the smart pivot. I'll just learn to trade manually. And I spent the next 2 years on the strategy roller coaster. Most of the viewers right now know what I'm talking about. Course after course, academy after academy, then I came across Trading in the Zone. I read the book not once but 3 times. Every time something clicked, and on the 3rd time I had this moment where everything actually finally clicked. Because every concept Douglas was teaching in the book, every single one of them was describing what an automated trading system already does. The moment you press start, that's when I went back to algorithmic trading. But this time, I understand why. Trading in the Zone isn't really a book about trading. It's a book about thinking like a machine. Douglas spends 200 pages trying to teach humans to be detached, statistical, emotional, neutral, and perfectly consistent in execution. Which is, let's be honest, every single thing an expert advisor already does the moment you turn it on a chart. Now, if you haven't read Trading in the Zone before, that's totally fine. You don't need to. What I'm going to do is walk you through the 5 core ideas in the book, in plain language, and show you why each one is really about algorithmic trading at the end of the day. By the end of this, you will have everything you need from the book without having to listen to 8 hours of audio. And if you have read it, this is going to make you see it in a totally different way. Here is the thesis I want you to hold on to for the rest of this video, because it's the one line that changed how I think about all of this. Quants and algorithmic trading don't try to identify an edge. They look at probabilities. That's it. That's the whole game. Manual traders spend years trying to develop the discipline to think this way. An expert advisor is born with this discipline in its DNA, because at the end of the day, it's just a code. So let's go through Douglas' 5 truths one at a time. And you tell me if they sound like psychology or if they sound like a code. Now, let's talk about these core ideas one by one. The first truth he writes about is this: anything can happen. Doesn't matter how good your setup is, doesn't matter how much you've prepared. The market does not care. Now, here is why this matters for you, even if you've never opened the book. If you're a manual trader, this truth is supposed to keep you humble, stops you from getting attached to a single trade. But honestly, most manual traders read this not and then size up the moment they get a high conviction setup. Because being humble in theory and being humble when there is a real money on the line are completely different things. Now, flip that to algorithmic trading. You spend weeks optimizing an expert advisor. Real tick data, in sample, out of sample, the equity curve looks beautiful, you go live. And 3 weeks in, a major economic event drops overnight. The market gaps and your perfectly optimized strategy is void for an entire month. Anything can happen. The expert advisor doesn't argue with that. It does not take it personally. It does not reverse trade. It just keeps running its rules, and that month gets absorbed into the long-term distribution within a properly balanced quant portfolio. You can spend a year trying to understand this from a manual trading standpoint, or you can just press start on your Algo trading platform and leave it to do its job. The second truth: you don't need to know what's going to happen next to make money. Now, this one sounds obvious when you read it, but it cuts deeper than people realize. Most manual traders are addicted to prediction. The whole reason they keep hopping from one strategy to the next is that they are searching for the one that finally tells them what's about to happen. Indicators, harmonic patterns, news plays, it's all an attempt to know the unknown. Douglas' whole point is that the second you stop trying to predict, you start being able to actually trade. And here is where I have to come clean about something. When I first got into algorithmic trading, I genuinely thought the expert advisors or the algos could predict the future. I thought a smart person somewhere in the world had some advanced mathematics under the hood that gave them a glimpse of what was coming. They don't. None of them do. If they did, every algo trader on the planet would be a billionaire by now. And I will be recording this video from a yacht. An expert advisor does not predict, it reacts. It has rules for when conditions match, open a trade. It has other rules for when the trade goes against it, close the trade. That's it. There is no crystal ball. The whole machine runs on if this, then that. Not, I think this is going to happen. Which is why when people ask me what makes a very good expert advisor, my answer almost never starts with the entry logic. It starts with the risk management. How does the expert advisor size position? What's the stop loss logic? What happens when a trade goes against it? Because if you're not predicting, and you're not, then the only thing that actually matters is how you handle being wrong. Manual traders spend years trying to stop predicting. An expert advisor was never going to do it in the first place. The third truth is one most traders skip past too quickly. Wins and losses are randomly distributed. Now, what does that actually mean? It means even if your strategy has a real edge, let's say it wins 60% of the time, those wins and losses don't come in any particular order. You can have 10 losses in a row and still be statistically inside what's your edge look like. Most manual traders cannot sit with that. They take 5 losses in a row, decide that the strategy is broken, and start hunting the next one, which is exactly what I did for the first 2 years of my manual trading. And here is where I want to push back on something Douglas implies, that you have to develop the mental discipline to sit through these tricks. I don't think you have to. I think a properly backtested algorithmic system is the best emotional trainer you can possibly have. And let me explain why. When I run a backtest on an expert advisor, I'm not just looking at the equity curve and the profit factor. I'm specifically looking at the worst losing streaks the strategy have ever produced. How many trades in a row has it lost in the past? What was the deepest drawdown? How long did it take to recover? Because the moment I have those numbers, the moment I've seen the strategy lose 9 trades in a row and recover, I'm psychologically armored for when it happens live. It's not a surprise. It's not a panic moment. It's just another trading day. History does not repeat in the future, but it rhymes. The expert advisor doesn't just execute a strategy. The backtest shows you what living with that strategy actually feels like before you risk a single dollar. That's the part manual traders never get. They're trying to develop discipline through willpower. I let the backtest do that work for me. Manual traders try to develop the mental strength to survive a losing streak. Algo traders have already lived through them while doing the backtest and optimization on paper before any money was on them. Quick thing. If this is making you think differently, a like genuinely helps. Most people watching aren't subscribed, and that click tells YouTube to show this to other traders. Alright, next 2 truths are the most important ones. Now we are at the truth that hit me hardest on that third listen of the book. An edge is nothing more than an indication of higher probability, not certainty, not prediction. Just a slightly higher probability of one outcome over another. And this is the line I want you to remember from this entire video. Quants doesn't try to identify an edge. They look at probabilities. That's it. That's the whole game. Manual traders spend years trying to find their edge, but an edge isn't a thing you find. It's a number you measure. Higher probability of one outcome over another, validated across thousands of trades. And here is where this gets complicated. To know if a strategy is actually real and profitable, you need to test hundreds of trades across years of data with realistic execution, slippage, spread, delay, all of it. Now, imagine trying to do this as a manual trader, by hand. It's not just slow, it's mathematically impossible. Manual traders are trying to measure probability with the one tool that cannot measure probability at scale, their own brain. An algo trader has the only tool that can. Douglas spent a chapter teaching humans to think statistically. An expert advisor cannot think any other way. The fifth and the final truth. Every moment in the market is unique. The conditions that made your strategy print last quarter might be gone next quarter. Past performance doesn't owe you anything. Now, here is why this matters for you. Even if you have never opened the book, most manual traders intellectually agree with this. But emotionally, they treat past performance like a contract. The strategy worked last month, so it should work this month. The setup printed 3 times this week, so it will print again today. And when the market shifts, they keep applying the same playbook to conditions that don't exist anymore until the account is gone. Now think about how an algo trader handles this. You don't optimize once and walk away. You re-optimize on rolling windows. You run walk-forward tests. You diversify across pairs and across strategy types. Trend following on one expert advisor, mean reversion on another expert advisor, and breakout on a third. So, when the market changes characteristics, and it always does, you're not betting your account on one set of conditions persisting forever. Manual traders treat the past like a promise. Algo traders treat it like a sample, and they keep updating this sample. Douglas spent a chapter teaching humans to accept that every moment in the market is new. An algo trader's entire workflow is built on that assumption. And here is what I want to leave you with about this book. Douglas was not wrong. Everything he wrote about, every truth, every chapter was absolutely correct. He spent his entire career teaching humans how to think like machines. The punchline is that machines were always going to be better at it. Stop asking this question. How do I become disciplined enough to trade well? That's the wrong question. The right one is, why are you trying to become a thing that could just be automated? Simply put, you don't have to develop the discipline to think statistically. You can deploy a system that already does. Stop trying to be in the zone and automate it. Now, if this video made the psychological case for algo trading, your next one would be the practical one. I broke down exactly why manual trading hits a hard structural ceiling, backtesting, emotional execution, prop firm rules, all of it, and why algorithms aren't just an alternative. They are the structurally safer path for most retail traders. Click here to watch it next. It's a natural follow-up to everything we just talked about today. See you next week.